Abhishek, we've done it a couple of times in person, of course. But this time I got more questions for you. I think I'll start with a very, very basic question. So
Sure.
we're listening of so many things happening in India, Abhishek, and I mean we spoke about the fact that India's own consumption, domestic consumption, is 65% of the GDP. It's growing fast. So much happening in India. Why suddenly exports? I mean, how does this theme even resonate as an investment idea?
No, no, a very valid question. Trust me, when I presented this idea to my IC, they had the similar thought process, right? So yours not a new one. Let me just take you through the thought process which got us here. So typically, just like a normal exercise, whenever a result season concludes, we typically look for kind of coming through the management commentary or the con call transcripts, try to figure out if there is a trend which is emerging. Luckily, as this time we were going through these transcripts, we realized that few of the export-oriented businesses they have started sounding more optimistic than what we have heard in the last 3-4 quarters. They started sounding the fact that discretionary spends which were put on hold have come back. Inflationary pressure more felt because of energy crisis has now again kind of being more tamed out. The fact that if system had excess inventory earlier, that is also now being taken care of. So broadly, you got a pretty comforting commentary from few of these companies exposed to exports. We thought, okay, let's just kind of vouch and try to find out if there is more to it. We try to look at somebody who is a third party who probably obviously won't have a vested interest here. Luckily, we found World Bank data. The World Bank data also suggests on the similar lines that when we looked at it, right, uh, in 2023 and practically post COVID, most of these developed nations are still struggling to find their own feet to find recovery get in place. Even in 2023, almost five nations, large nations in the world, namely UK, Germany, Saudi, Argentina, Norway, and others, were in a recessionary mode. Luckily, when you look at 2024, which is the current year, out of those five, only two are expected to continue in a downward trend. Hopefully and luckily, by the again World Bank projection, next year none of them are going to be in recessionary mode. So practically, we saw that if you look at a global scale, things are kind of plateauing out. What we saw, we also heard the commentary which gave us comfort at the business level. Last but not the least, we kind of refer to the outlook with the Indian government is now sharing, where they want India to become a $2 trillion export market by end of this decade. So clearly, we believe that the government is putting its own weight behind something which is so instrumental. The fact that the companies are sounding more optimistic, as well as the World Bank has kind of given you a more optimistic outlook at the overall world economic recovery phase. So these two, three things coming together gave us a confidence that is this something which is probably you are scratching the bottom of the surface and trying to find an evolutionary opportunity here. And hence we are here with this product in front of you and our audience.
And Abhishek, when you now speak about the opportunity in the exports, we're not by any chance trying to discount what is happening in the Indian domestic consumption piece, right? That both of these things are working simultaneously, I assume.
For sure. So a great point to highlight it. So let's just think about it, right? When we are saying we're all trying to emphasize the fact that we're looking at opportunity and hence even the name of the product, which is HSBC India Export Opportunity. We're trying to find businesses which are incrementally becoming more relevant on a global scale, be it their size, be it their offering, be it their scale, be it the technology, whatever pushes them on a global scale. But their origin is clearly Indian, right? The fact that, and again, we ran some iterations at a portfolio level. Again, we try to figure out that what kind of exposure are we looking at when it look at the export opportunity here. In general, we found that about 60% revenue on average was working to be towards domestic orientation and about 40-45% was working towards the international orientation. So it's a pretty good judicious blend. Obviously, we are not ignoring what's happening on ground. We are just trying to find businesses which are going to incrementally gain market share, more opportunity going into the future.
So that's an interesting point, Abhishek. So if I summarize, you're saying these are Indian industries which may be producing for the export market as well. So you are not discounting what they do for India, but you're also bringing in the extra opportunity that comes in with the fact that they're also exporting and so on and so forth.
Totally, totally, and that's why the term opportunity is so relevant in this.
Interesting, super. So Abhishek, when you look at the different themes that are playing out
Hmm.
in the Indian export opportunities, what are the top two or three or four themes that you think are really critical, and which really are going to play out over the medium to long term?
Yeah, so again, if you think about it, and that's what I've been saying, that this has to be seen more as a umbrella strategy, right? If I can probably just take you a step back, just think about it, any nation, any country, for it to achieve its true potential, I think there are two main baskets. One is domestic, the other is exports. This is like the twin engine of an aircraft. They have to fire together to take you from point A to point B. So if India aspires to be a developed nation by 2047, I think both these engines have to fire together. And that is where I think a lot of these evolving themes which we are going to discuss are going to have equal opportunities both in domestic and export. But we believe that with incremental impetus on export, we are going to get probably an opportunity to find better opportunities from a business and a portfolio construction. So let me enumerate some of the themes which probably can play out, right? If you just probably roll back in last 15, 16, 18 months, you would have heard there is a lot of impetus in towards defense. We're talking about manufacturing as a theme. We're talking about auto ancillary, EV evolution, clean tech as an opportunity. We're even talking about innovation as an area of investment. We are even talking about discretionary consumption as a basket of opportunity, right? Now, if you put all these five broad mega trends, if you can call them so, almost each of them will have a fair representation from an export opportunity basket. So that's the unique feature about this product. We are not alluding to just one or two because intuitively, and I've seen this, I've taken this poll whenever I've addressed people in person. Invariably, the assumption is we're only talking about technology and we're talking about at best pharmaceutical. But practically, yes, those are the pillars where we already proven our capability, but they are far and beyond that. Machinery, they are even evolving themes, right? So let me just talk about it. So we all have heard that India's PLI, which is again the core epitome around which we want to focus our own manufacturing roadmap, where India wants it to move from 15% of manufacturing percentage of GDP 20% by end of this decade. I think a lot of these new industries, where 14 industries have committed to be part of PLI scheme, they're starting as import substitution, but trust me, over a period of time, they will also become the champions of the world and they will also start contributing towards exports. So I think at a theme level, they are wide and many. So clearly, this is a portfolio which will give you that benefit of diversification playing across so many themes.
So interesting, Abhishek, and we will talk a bit about services, but slightly later. I've already got a couple of questions. So the first question seems to be, which companies is this fund really going to invest in? I know we've got restrictions, but Abhishek, give us a sense of what we're talking about here.
For sure, for sure. So you touch upon it. Let's say, as you know, I think probably let's just split our exports in two main buckets, services and merchandise, and then look at it what kind of opportunities we find in most of these both of the buckets. Again, some data point for the reference of everyone here. India is the fifth largest economy in the world, and India has about 4% representation in the global GDP. Right now, if you look at services, India is 4.3% market share in a global service exporter nation when it comes to the absolute market presence. And coincidentally, we're also the fifth largest service exporter in the world. So the point here is that India is not over indexed. So people generally will believe that our technology is already at a level where the growth becomes difficult. We already have a scale and size where incremental market share gain will be difficult, but that's not the fact. The very fact that India's services exposure is just exposed to the right size. And if you look at it, the fact that you're talking about pure tech services as almost two-thirds of this composition of $341 billion, so about $220 billion plus is coming from purely your tech. There are so many more nuances to it. Let me pick one, GCC. I'm sure all of us have heard this name in last 1 month, right? So GCC stands for Global Competency Centers. Now these are the entities which are set up by the MNCs who want to take advantage of both skills and abundance of labor along with the cheaper cost of delivery. These three things coming together has led to such great opportunity to the fact that GCC, which probably was less than a $20 billion overall offering just few years back, today is a $46 billion offering in terms of revenues. You have already 1700 plus GCC centers installed in India with about 2 million employees working there. So it's already sizable, but now just look about the size which it can attain. So these are NASSCOM projections. NASSCOM says that this size of 46 billion can become 100 billion. They're saying this 2 million employee base can become 4.5 million employee base. They're saying these 1700 centers can become 2700 centers. So I think clearly there are so many sub themes and nuances which are part of these two broader themes where you will have enough opportunities to evaluate from. Again, just to give you one more cut on services, we understand that two-thirds of our services component comes from your tech and the other professional services. The remaining one-third, which is predominantly focused over logistics, transport, and financials. Now, we've all heard that India is aiming to take our digital solution like UPI to Singapore, France, and other countries in the world, right? Whenever you kind of again capture that part of the opportunity, that will be a part of services income, which will again keep growing along the fact as we keep expanding our global presence. So the fact that India has proposed this $340 billion bucket to become $1 trillion in a matter of next 7 years, we are talking about a CAGR growth ranging between 16 to 18%. Now understand the underlying economic growth we are talking about of a country like India size and scale is a $10, 10% on a nominal basis. Versus that, there is a services basket which is expected to grow at a 1.6, 1.8 time. So clearly, I think there are enough opportunities which lie within the service basket. And this is exactly what we wanted to bring to your knowledge.
So Abhishek, we'll speak about GCC. Before that, two quick questions. I'm going to have lots of questions actually. I'll answer this. This one question which says, what is minimum and maximum amount to invest? So you can invest a 500 rupee SIP as well. And how much maximum? Well, there is no maximum. You can invest as much as you want. Abhishek will be more than happy to take any amount of money that you give it across to him to manage. The second question is, can NRIs invest in the fund? Yes, absolutely. There are specific ways in which NRIs can open their wealth management accounts. If you do not bank with HSBC, please feel free to reach out to us. We'll be more than happy to help. And yes, like I said, NRIs can invest. Abhishek, so back to you. We spoke about this, in fact, at least in a couple of instances on the GCC piece. Abhishek, HSBC itself is, I think, one of the largest, runs one of
Yes,
the
right.
largest GCC in India, about 40 or
Yeah.
1,000 people. But most of these GCCs are multinational companies. They are not really listed in India. Not too
Hmm.
many of them also seem to have a plan to list in India. So while it's a great segment, but as an investor, do I really get an opportunity to own some of this opportunity, some of this investment space, or
Hmm.
are we just thinking before our time? I mean, what do you think?
No, no, completely. You're right. So yes. First of all, let's just think from an economic level, and then we'll talk about the investable opportunity. So, as an economy level, it doesn't matter to me whether you work with a company or a company B, as long as you are as a civilian of this country, gainfully employed. Clearly, that creates that incremental per capita income, which will eventually help in a nation to kind of keep building, again having more per capita disposable income, which will again be working towards enhancing the overall standing of the economy. So from economic standpoint, it doesn't really matter. Yes, from an investment perspective now, you may believe that yes, and again for that you have to rewind a bit. GCC wave in India is not the first time. We have been seeing India's GCC waves coming and going since 2000. Rather, if you can quantify, this is probably the fourth wave of GCC we have seen in the country. And invariably, understand from a business perspective, right? What may be your strategic priorities today may not be your strategic priorities 5 years down the line. Businesses evolve. The reason to focus on those strategic focuses change. So maybe a entity is setting up a GCC today because it wants to take advantage of clearly the size, scale, and cheaper cost of delivery. But more importantly, they're setting it up because they realize it's something which is very core to them. Now, with the passage of time, most of these things will become by default commodity in terms of delivery. This is such a competitive world that anything you do remains only unique for a given period of time. After that, anyone and everyone can emulate you. So, with a similar thought process, once you realize that these unique proposition advantages which were there with you has now been diluted, and this is a proven fact that the cost of delivery at GCC is 20% higher than a tech-enabled delivery in the same country. So, let's again, I'm just like taking name for example's sake. The top tech service company like Infosys, TCS, Wipros, and other, if they would be running your center, they would be running same output at 20% lower cost. This is a proven fact. So the companies have still chosen to be in GCC because they realize there is a value here which they cannot let go. But over a period of time, these companies will eventually take it over. And I'll quote some instances. We have seen case of Citi handing over its GCC to TCS. We have seen UBS handing over its center to Wipro. We have seen State Street offering it to HCL Tech, Texas Instrument offering to HCL Tech, and there are numerous and more, right? So the fact of the matter is you will eventually have a role to play here. At this moment, at the starting point, they are even the company which have become smart enough. They realize that either you let it go completely or you become part of the ecosystem. So they have started proposing setting up dedicated centers for client to meet his or her requirement. in the fashion that they are completely secured about the fact that their USP is staying with them, it's not going out, and yet become a participant along with the emerging opportunities on day one. And as and when they think it's time to kind of sell their stake, they hand it over the existing operations to the company which are already running it, and in that process ensures continuity of the business. This is direct engagement. There are even indirect engagement which are a possibility, right? So once GCC are setting up, you need commercial buildings. So anyone who is dependent on real estate as an offering, which is a great commercial development, will have an opportunity to play here. Similarly, these GCCs are setting up. They also need data centers because they need again places where they can stack their data center servers. So anyone who is involved in a business of data center will have an indirect play towards it. We all know GCC, as I mentioned, is 2 million employees currently and about 4 million, 4.5 million projected to be in next 7 years. Anyone who is engaged in terms of providing these staffing solutions will again have a role here. So I think if you look at from an overall ecosystem, there are numerous opportunities directly or indirectly which can have a say here.
Interesting. I'm frankly getting a lot of questions, and I'm just looking at the chat box here. There's one which I'll come back to you. This on how the where this should, which part of the portfolio should this fund come in. But I've got another interesting one, and this is, I guess, something that you will get challenged on. And the question is highly doubtful to see such big numbers because everything shall depend on transition of business from major countries. I think we get it. Basically, if you are saying it's GCC, you have to get work sort of imported in from there into India. Isn't there too much dependence? Are we riding too much on a theme which is not yet really live?
No, so point well taken. And I think that's where I alluded to, right? The underlying assumption here is that India is already over indexed on the services side, more specifically on the computer services side. But if you just go by the data, and I'll rather ask you to kind of just evaluate it from a long-term theme perspective, the fact that India started with 2% market share in the global services export bucket just two decades back. Today we have 4.3, and luckily, you take any 5-year window. In any of these 5-year window, India has only gained its market share on the services export side. So clearly, I think there is so much more which can still be tapped into. And again, just again, a reference point here. So I was reading this somewhere that today about 60 or 80, somewhere 60 to 80 global MNCs, which are more again dependent or which believe tech is their main go-to market offering, those CEOs have relocated and made India as their headquarter. Now just think about it, how many expats, as you yourself were referring way back when we used to travel, we used to find that as an opportunity. The fact that now there is actually a reverse migration. These CEOs of the businesses are coming to India, making it a headquarter because they realize that India is now even leading. And again, our data here, which is very interesting. So when I say GCC, right, GCC has different value proposition. It starts with the pure cost opportunity or the lower cost of delivery. And it goes all the way to research and engineering and development aspect, which is the business leading spends which you do at a company level, at organization level. The fact that in last 8 years, we have seen India's engineering and R&D spend grow at a much faster clip. So from a $10 billion bucket, it's now a $26 billion bucket in a matter of 8 years. While the other two part of the component, which are lower value add, have still doubled, but they have not maintained the similar pace what you're seeing on the R&D side. So clearly, I think I'm very, very convinced and hopeful that with the kind of investments we are kind of listening, finding, and the kind of commitment you are seeing with each passing day, it's a number which can for sure be attained. So I'm not uncertain about it. The fact that India has been ever evolving on the technology landscape. So one question which I keep getting asked, and I'm kind of again preempting it, people will ask me with the GNI evolution, with AI, how much incremental opportunity can India can offer, right? But I'll just take you through again, given I have the kind of had the privilege of cover this sector, technology specifically for almost 2 decades. I can tell you every decade, whether it's 2000 to 2010, 10 to 20, 2030 right now, every decade there has been a change which has been coming through where everyone writes an obituary for Indian tech services. Whether it was in 2004-5 when we talk about system integration, in 2014-15 when we talked about SMAC evolution, in 2023-24 we're talking about digital and AI. Luckily, yes, India takes its own sweet time to adopt any technology. We are never the first mover, but our size, scale, and inherent capability, right? So data here again, India generates 25 lakh science and math graduates in the world, the highest in the world. When you again cut them in terms of their skill sets, basic, intermediary, and advanced, you will be surprised to know even on a basic and intermediary level, we have the highest number of employed skilled people. So not only absolute big pool, but again on skill set, one of the best skilled pool. So when you deploy these kind of people at work, I think I'm 100% sure we are well on course to attain these numbers. There could be mid-term volatility, but from a 5-year window, we are well on course.
Interesting stuff. And there are going to be sub themes that are playing out. When you say
Exactly.
services, it is not just a kind. There are many other sub themes that guess should play out, right?
Totally.
And so we've spoken a bit about services. I think a lot of us recognize that it's very visible. Let's come to the theme around manufacturing or merchandise exports.
Yes.
Um,
Yes.
how are we placed on these? Which are the growth drivers really driving that piece? Because there is far higher dependence on things happening domestically on this piece. So why
Yeah.
don't you share a bit about what really is happening here? What are the drivers? Which way do you see this entire piece moving?
No, no, totally. And I think this is exactly where I believe that there is so much of underbelly which can be exposed and can give you opportunity. So in my mind, it's a migration from Bharat to India. And we clearly will find an opportunity here. Just to put some numbers here again, as I referred, India is the fifth largest services exporter in the world with about 4.3% market share. Now, coming to merchandise, India has got 1.8% market share in the global export market when it comes to merchandise. It makes us the 17th largest. Now, so a country which is the fifth largest economy in the world is just being 17th largest exporter on the merchandise side. Clearly, we are under indexed there, right? There is clearly a need for us to do something to get the right standing on this side. The very fact that there are so many efforts which will be taken, and again, let me just put a number here. So the government wants India's $441 billion exports merchandise basket, which is today, to again take it to $1 trillion number by end of this decade, which would again mean we're talking about more than doubling. So the good part is, again, if the underlying GDP is projected to grow at 10% on a nominal basis, the manufacturing base or the merchandise will still grow faster than that at a proportion of about 1.2, 1.3x.
Hmm.
So what's been done here, right? Clearly the question. So we were also inquisitive that the fact that India today is just 15% manufacturing base, how do we even propose to attain these numbers? So first, we clearly saw, as I mentioned, there is a clear impetus of the government. So let's talk about PLI, as I talked about, but let me just again encapsulate what's happening there. There are about 14 industries which have already been part of PLI mechanism. Till 2023 end, almost 4.5 lakh crores of capex commitments were promised under this PLI scheme. Almost half of this will be spent by government itself. So practically, as a business, I have to barely spend half of the overall capex. With that capex coming into play, and assuming this execution comes by FY28, which is the sunset year for the PLI to claim those benefits, you are expecting almost 12, 13 lakh crores of incremental revenue. That's almost 3.5% of India's GDP. So that's the kind of money which can get generated incrementally by just one government initiative, which is PLI. Now you take another initiative, which is again where government realizes that we need to
So you
integrate
you see,
ourselves. Uh, did I lose some? Is it
hey, I lost you for 30 seconds, Abhijit.
perfect? So I was referring to the PLI, and in the crux, I was mentioning that almost uh, we were saying that there is going to be 4.5 lakh crores of investment, where half of that will come from industry, and for that, almost 3.5% of incremental GDP addition can come through. So that's the kind of number we're looking at purely just by one scheme, which is PLI. Now superimpose it with what government is doing in terms of realizing that we need to be well integrated on the global value chain. So to achieve that, India currently is in either discussion or has concluded discussion with almost 20 countries and trade blocs for FTA arrangement. Now, the free trade arrangement or agreement, as it's called, what it does not give you any added advantage, but it rather takes away any disadvantage which you had with other competitive income countries till the time you had this in place. So again, a case in point. So India signed its FTA with UAE sometime back. Luckily, if you look at the kind of traction the business has seen with UAE, now we have grown at 24% plus CAGR with UAE, while the India's exports have only grown at 10%. To an extent that now UAE has become the second important trade partner for us after USA on the export side of the merchandise.
Hmm.
So clearly, government policies, initiative, and the right decision to become more integrated with the global value chain can give you so many opportunities. Let me talk about some of the sectors, right? You talked about what sectors you can look at. So as I mentioned, I think it ranges whole hog. You can start with purely just the machinery. So the machine and the finished capital goods export is a big theme. India already has kind of proven its mettle there. Chemicals, specialty chemicals, again, something where we have been gaining market share. Pharmaceutical is clearly an edge where we are incrementally doing more. There are opportunities even in terms of, let's say, clean tech side. So EV components, even looking at the solar modules, looking at electrolyzers which we're developing today is an evolving theme where we will have opportunity to explore. Defense exports, you would have heard that the government wants to focus so much around that. Today
Hmm.
it's just a $2.5 billion, but India wants to take it to $10 billion by end of this decade. Again, an evolving space where the manufacturing can come into play. Luckily, we just came across two or three reports, and just we wanted to make sure that we are not again being too overly optimistic about this opportunity. So we ran through some of the reports from Bain Consulting, Nomura, Goldman Sachs, KPMG. Luckily, all these three, four independent players have a view that India is well on course to achieve these targets. These targets are ambitious but not ostentatious. So clearly, they are within the achievable zone for us, provided the executions comes in forth. They have talked
Hmm.
about various sectors ranging from chemical to textiles to electronics to capital good engineering to petroleum. So I think they are numerous and galore. We again don't run short of opportunities. The fact that we are focusing on execution will only give that impetus when it comes to merchandise exports also.
Interesting. I've got a question here which says, um, given the current market scenario, would a SIP be better or lump sum for this fund? I think my advice is, depending upon what your current portfolio looks like, you could choose both. A lump sum, of course, given that you are doing an immediate allocation into the opportunity, given the idea is now building up. And on an ongoing basis, like Abhishek has mentioned, I think this idea will only keep growing from here. If you do a ongoing allocation, you will only get a better share of this story as you move forward. Abhishek, two very interesting questions, and I'm sure this is something that we not got elsewhere. The first one is, how is this fund targeting companies that can sustain competitiveness at global level? Considering the
Mhm.
fact that Indian exports are often challenged by lower cost producers like
Mm.
Vietnam and Bangladesh. It's obviously about the fact that traditionally cost is where people used to move to India.
Yeah.
We're now saying we're talking about capability and competitiveness. How does this balance happen? I mean, do you think this will really happen? How would we maintain the competitiveness?
No, no, very well, and I mean, yeah, this is again something which we had to dwell our mind at and think about it, right? So the good point is, and again, this is another pillar which gives us a lot of confidence. And I did allude to when I was talking about GCC as an opportunity. But the fact that India realizes we are the most populous country in the world today. So clearly, availability of labor is not a constraint, but we want our labor to come with the benefit, twin benefit of delivery, cost of delivery, as well as skill sets. Now, whenever you gainfully employ these labor or this overall population, you will be moving up the value curve. Let me again take an example. And the competition you were referring to, typically it's seen in the field of textile. So if you're talking about India's textile, right? In 2014, we had about mid-teens kind of exposure towards overall export basket or merchandise. Today, as we speak, it's sub 10%. So clearly, style has lost its relevance. So the point is valid that if it's only the cost arbitrage platform which you take to the global scale, then any country which can offer similar price point, you tend to lose your competitive advantage. So how do
Right.
you sustain that advantage for long? You have to sustain that advantage in two fashion. One, you have to keep moving up the value curve, right? So from pure yarn manufacturer to a fabric manufacturer, from fabric to ready-made garments to technical textiles to product and PPE, what you call it. So practically at every level, you keep migrating upwards on the value curve. Two good advantages of moving up the value curve is one, as you keep moving up, there's a lesser competitive intensity while you will find at the commodity level of delivery. And
Hmm.
second, as you move up the value curve, your typical profitability is much higher than again you will find in the commodity side of the basket. So
Hmm.
not only you are moving up the value curve in terms of lesser competition, but your returns are also that much more stronger, and you are more sticky to your customer, because for that customer also you become a strategic vendor. There aren't many, and if you are kind of meeting his requirement of both cost as well as skill as well as whatever they want from you, then invariably you find the client also leaving you just for few nuances, right? So few dollars, few pennies are not something which is relevant there. Second important thing is again, so that's moving up the value curve within the pie. The second is again increasing or expanding our overall skill sets. So when India has the advantage of the lower cost of delivery in terms of cheap labor, but as these labor migrate to bigger skill sets, and that is where when I mentioned you, if you think about it, in technology space, in even in let's say for an example in electronic manufacturing space, right? India's market share in electronic manufacturing about 10 years back was barely 2%. Today we're already 6% and we are just moving up the value curve. The very fact that today Apple, one in every seven iPhone which is made in the world is manufactured in India. And again, if you go by the commitments which have already been made, it's a matter of time before one in every third or one in every fourth will be made in India. So clearly, now think about it. Somebody who's so conscious about the aesthetics of a product, the quality of a product, they will obviously not come to you for few dollar benefit. The fact that you moved up the value curve, you started offering both benefits of skill, technology, and engineering. As you do that, you become more entrenched in the customer, and that is where you maintain your competitive advantage. So I think India realizes that, and once we start moving in that direction, we will become more relevant in the overall scheme of things.
So all the building blocks of competitiveness is in place, being built up to an extent that you would really continue to have a sustainable competitive edge over a period of time. Obviously, not forever, perhaps, but for a reasonable period of time from here. Abhishek, so one question around the fund management itself. I think one of the questions that we've got here is how would the fund react to the global interest rate cycle, especially with respect to developed economies that we majorly are trading partners with.
Perfect, perfect. So I was expecting a question on the global economic outlook. Here's the one. So I think again we evaluated this because although as I said initially, we are seeing that initial tapering off from being a bottom of the global environment to something which is going to take a upward trajectory. Now, gradient of recovery, no one is taking a call right now. We are just kind of getting comfortable with the fact that the bad news is already discounted. But again at some level be a little more cautious about the fact that we don't want to build that in our optimism. We evaluated how India has fared over last 20-25 years in a global scale. So what does it take? It helps you to then negate any vagaries of the economic cycle. And it again gives you how India has been doing on a more relative largest point of time, right? So the data which came across was very interesting. In 2001, India's market share in the overall global export market was just 1%. Today, as we speak, we are 2.3%. So over a period of 25 years, one can say it's a very slow grind, but we are also talking about a market size which is at $35 trillion. So it's a big size market itself, almost 7 times of India's GDP itself, right? 7, 8 times. So luckily, when we evaluated this in the context that how Indian share or market share in the export market has fared through various economic cycles of boom and bust, depression, recession, and everything. Luckily, we didn't find any of the year in this 24-year cycle where India has lost its market share ever, even in good times or bad times. That gives us confidence that inherently India is bringing something to the table, which is your unique advantage, right? Which is like core to you. So no matter whether economic outlook is good or bad, because you have a value proposition, you keep gaining market share. Again, now just to put a context here, as you said, what would happen and how would you react to the interest rate cycle? First of all, we have seen already 2, 3 large nations already started to cut down on the interest rate cycle. There is an imminent expectation that US will also be on the same path in this month itself when they have that. So clearly, I think interest rate cut is also a precursor to the fact that most of these Feds or the central chair are comfortable with the inflation expectations. Once the inflation tames off, then clearly interest rate regime. So why do you increase interest rate? If we just kind of give you a 101 on economics, you increase interest rate in during inflationary environment, you so that you put artificial brake to the economy. The
Hmm.
moment you realize that inflation is now tamed, you want to release those brakes. So the interest rate cycle coming down is releasing those brakes. And as and when you release those brakes, rather than being worried about that, will it lead to further slowdown of the momentum? In my mind, it will at some point of time help towards catching up the momentum of the overall economy. So the fact that higher interest rate at some level dissuade you from any kind of discretionary spend, it dissuades you from taking any kind of capital commitment which may not be ROE accretive immediately, and you are just running business to be more just sustaining rather than growing. With the falling interest rate cycle, all of that tendency tend to reverse. So in my mind, with the falling interest rate cycle, there would be a lot of opportunities which would be there. And the fact that India is merely 2.3% market share globally, and as we discussed, so many building blocks which give us comfort, I'm 100% sure that this trajectory is only going one way, which is upwards. As I said, gradient, no one taking a call, but clearly this is going to be positive when it comes to a country like India, because there's a very interesting stat when people looked at it, that if, and we have seen now in last 4 to 8 years, most of these countries have become inward looking, right? Everyone is talking about nationalism, everyone is talking about trade barriers. In that context, when you look at it, the fact that India has still been gaining market share when the world was going through its grappling with its own growth struggle, which is again from year 2020 to 2024, India was still growing. So no matter what the cut of the global economy is, India has just been gaining market share because of the value proposition which we bring. And with incremental impetus that the government wants to put now versus whenever in the history we have done that, plus our geopolitical positioning today. I think these all factors come together to give us a lot of comfort about the fact that we are on a right trajectory.
Interesting. I have an interesting question coming up on where this portfolio should basically figure. The question is, export or opportunities fund has been rated very high risk. What should be the ideal allocation percentage in individual's portfolio? Maybe I should answer that question. So, any allocation to any investment has to be dependent upon your own risk rating, your own risk profile, your own ability to take a particular kind of risk, to what level, for how long, and with your goals that you are really wanting to achieve. I think it's a combination of these two factors. So, whenever you consider any investment, you must take these things into account. It is a high risk product fundamentally because it is an equity product. And equity, of course, are volatile in the short run, but very, very stable over the long run. Just to share, over the last, I think, decade, the Indian equity markets would have returned 12%, 12.5%, 13% CAGR on a month-on-month, on a year-on-year basis, which perhaps is the largest that any large-size economy has done across the world. So India is doing very, very well. But if you obviously look at some days, the markets have gone down. Some days, the markets have not done well. There have been successive days of markets taking a beating. But in the long run, equity markets always do well. So the risk that you need to consider is your own ability to take risk, your own goals that you are planning to achieve through this. Talk to a financial planner. He or she will be the best person to really help you invest in that sense. Super. I'll come back to you, Abhishek, on another interesting question. And this is around the question that we were discussing initially. So a popular theme that we talk about nowadays is consumption. Does the export theme complement that, or are they unrelated to each other?
Not at all. Rather, as you said, right? Uh, First of all, consumption will surprise, and we ourselves were surprised when we were scrumming through data. There are already enough opportunities as an investable universe for me today to invest in businesses which are directly or indirectly dependent on the consumption basket, whether it's staple or discretionary spending. So first of all, as an opportunity, say there are enough opportunity from this portfolio perspective. I have to evaluate an opportunity from that angle. As I told you, right? The moot point here is we are still looking at almost 60% revenue composition, which is domestic in nature. So we are not ignoring a domestic market. We know India is the fastest growing economy in the world among the larger ones. All we are saying is that we also find opportunities where Indian companies are becoming more relevant. They are attaining size, scale, skill. They are making that opportunity, capitalizing on it. And that is where we want to have that focus approach to find those nuances, those opportunities, which will take the portfolio to a much higher level when it comes to generating a more steady state performance. To answer directly on consumption, as I said, there are first of all enough opportunities from an export orientation perspective also. Then I want to put another important aspect for the portfolio. So if we think about it, right, ultimately, if these economies or these businesses are going to get focused towards exports orientation, these businesses are served by you, me, and everyone like us. So practically, with the businesses growing, the per capita income grows. That per capita income growth will lead to higher discretionary spend in the economy, and hence everyone benefits from it. Again, a very interesting data point. Typically, it's been seen that businesses which are more export oriented, with the benefit of operating leverage, they typically tend to enjoy more profitability. Their return profiles are far higher when you invest in global businesses rather than you look at domestic business. But again, a very logical way to look at it. When you're competing domestically, all your inherent advantages which you take to the global scale, whether it's availability of labor, cost advantage, or technological advantages, distribution benefit, most of them are there for even anyone else to capture or capitalize on. But when you take these advantages to global scale, you are competing with the other countries and the other companies which may or may not have these advantages. So clearly there is that extra producer surplus which you can capture here, that again would have the benefit from a consumption side of the story. So I think yes, consumption for sure is not excluded from this product. It will give impetus towards the consumption also at a countrywide level.
Abhishek, so the obvious question after this would be that we've spoken about what really is playing out. We've spoken about the opportunity. We've spoken about how competitive edge will be maintained. But as a fund manager, Abhishek, tell us what would your broad framework be for the portfolio construction? Also, do tell us what are the ideas. We talked about sub themes, right? What are the ideas that will really playing out in the portfolio? Are there any sectors, any particular industries which will choose not to invest in? Do share your insights on these, please.
Again, a very interesting question. So let me just take you through the ideology behind this portfolio. How do you want to run this, right? So as I said, funds are qualifying criteria to be eligible to be part of this portfolio was you should have at least 20% revenue coming from outside India. Again, mind you, as regulatory requirement, 80% of the portfolio has to comply with this export theme. 20% is at the discretion of the fund manager. So at least 80% of the portfolio has to have revenue exposure of more than 20% towards exports. We again inherently internally use a cutoff that we need at least 2000 crores plus market cap exposure, because that's where the impact costs get neutralized and you get find enough liquidity for a portfolio. When we ran these two screener, we were also surprised that we're talking about more than 300 names eligible to be part of this portfolio on day one. So that creates my universe, right? Again, if you look at from a split perspective, whether you look at split between goods and services, they are about 3/4 and 1/4 exposure between goods and services. You look at exposure between large, mid, and small, fairly represented. Rather, almost 87-88% of this universe is between mid and large, which again is kind of a portfolio manager delight, because that is where typically you find more alpha creative opportunities. When you talk about the sectoral exposures, as we have discussed, we have found almost 14-15 sectors and just not one or two which can be part of this theme on day one. I would rather say you name any sector, it by default become eligible for this. On the corollary, and this is exactly what you asked, that what will not be part of this portfolio. So first of all, any sector per se which is excessively dependent on just domestic opportunity. So the thing which comes to my mind, let's say banking, financials, retail, maybe real estate. So those sectors which are only and only relying on domestic opportunities, they clearly will not qualify to be part of this 80% of the portfolio. The remaining 20% will still give me some leeway if I find some long-term themes there to have a bit of exposure there. But if you think about it, and we want to run this portfolio on a multi-cap theme. So ethos would be that about 50% exposure towards large cap, about 50% exposure toward mid and small. So that gives you a well judicious blend of having exposure across market caps. If you compare this kind of a diversified strategy with a typical diversified strategy of either flexi or multi, you will realize that typically these funds have a very high exposure towards banking as a sector. Now, luckily, both by design and by choice, we want to maintain a lower financial weight in a portfolio. Again, just to prove the point, if you look at from our exposure across our equity schemes, we already are running a more conservative assessment on financial as a space from a next 2 to 3 year perspective. So again, this is a choice, and also by design, we get that advantage. Now, at a very top-down view, assume there is a component of the economy. If you think about India's economy expected to deliver a 10% CAGR, export as an overall basket expected to deliver 14 to 15% CAGR, we are taking away weight which is more exposed to 10% of the opportunity, which is financial, which is more domestically oriented, and putting that weight to the opportunity which is more of 14-15% exposure. So practically at a very blended level of portfolio creation, we are giving a portfolio which is inherently expected to deliver a far better return visibility than a pure only domestically oriented portfolio. So these are specific sectors where the underrepresentation would be there. But as I told you, again, one more cut to it, when we ran our iterations for the model portfolio creation, we were also positively surprised to find out that we are finding almost 4 to 5 different sectors where each of them will contribute individually about 10, 12, 15%. And the top 5 sectors were coming out to have exposure between 60 to 70%. So it's neither concentrated on any specific sector, yet gives you a very wide basket of 5 sectors representing 60-70% exposure. Another 3 to 5 sectors will make the remaining 30% cut. So the portfolio at any point of time will give you visibility of between 8 to 12 sectors. None of them more than 20-22%, which is also the highest, but overall top 5 at 60-70. Multi-cap ethos, spread across sectors, spread across market cap, spread across geographies. I think this is in true sense a diversified portfolio one can evaluate, and that's exactly what we're offering.
Very interesting. So we are basically saying that while it is thematic, it is actually a multi-cap theme. It's multi-sectoral theme. It is very, very widespread. And then from there, because you have a fairly wide range of stocks to choose from, over 300 odd stocks you mentioned,
Yes.
you obviously have a much, much greater sense of choice when you go for stock picking. So interesting. I have an interesting question on the textile industry, Abhishek, and this is also close to ESG. So let me ask this question in verbatim. It says, as you rightly mentioned about the value curve in the textile industry and manufacturing, into both these sectors, there are questions raised of sustainability. So how
Hmm.
will ESG play a role into your decision for export-driven companies?
No, no, clearly ESG and if you think through it, when we cut our lens and when we evaluate businesses, so understand ESG has 3 different components, right? So it's environment, it's social, it's governance. The problem is people associate ESG with only our environment part of the story. Yes, sustainability is important. I mean, we all have to live a world which is better for our children. So there is no question to that. But if you think from a perspective, I think we clearly see on when you talk about manufacturing, when you talk about the governance on the textile front, incrementally all the efforts again being taken by the industry itself, be it the pollution control board, which is making sure that the discharge, the residuals have to be treated before they're taken to kind of discharge and being just thrown in open, to something where you're seeing in terms of labor law practices, right? I think they have become far more stringent, and they're making sure that the human index or the human capability index are met to the fullest extent. So I think luckily, and this is where again export team has an advantage, because think about it, the businesses which qualify to be part of export, not only they meet all these regulatory requirement in India to first get approval, but they also have to meet the requirement or the qualifying criteria of the importing country. Now, if world over you have more stringent norms and requirement before which you cannot be part of the export value chain, then by default these businesses will have an inherent advantage in terms of quality, governance, and abiding by the sustainable principles. If you don't abide by them, then even if they produce the cheapest product, they will not be eligible for exports. So I think first the selection itself, being part of this opportunity set. Second, a very conscious effort at the government level. And last, the very fact that everyone realizes that the human capital is the most important capital for any industry, and you have to have right sustainable parameters around that. All these three will ensure that you are finding again a portfolio which is very good on the governance, sustainability, and the environmental aspects.
Superb. So ESG, of course, not small. It's not only about environment. There are many other elements playing out. And competitive edge is in many ways a byproduct of you having working within the ESG principle. So that's how you call it. Very interesting. Another interesting question, Abhishek. I think people really are finding the export idea very interesting to talk about. Says, how is India's infrastructure, ports, roads, airports, etc., standing currently, which could contribute to the increase in exports? So primarily,
Yeah.
is our infrastructure good enough to really sustain this entire export drive?
No, no, point well taken. And frankly, I did get this question asked earlier also. And to be fair, I did not have very concrete numbers with me, but luckily I went back and looked at this data. So to throw some numbers here, India today on the port side has about 1.6 million ton, 1.6 billion tons of installed port-based capacity across various ports coming together. If you think from a capacity throughput perspective, we are not even a billion tons throughput today. So we are right now utilizing barely 60% of our throughput capacity today. Port is one place where you can even hit more than 100% capacity throughput. So practically, as we speak today, we are not facing absolute constraint incrementally with benefit of DFC coming in, right? To think about both Western and the Eastern corridor, they will again ease the overall flow of the exempt trade either side. Now think about incrementally new ports which are coming. You would have heard in Maharashtra there is a big port which has been announced. Similarly, if you meet the private player, they're talking about setting up so many ports on the entire coastal line, ranging from eastern corridor to the western side of it. I think incrementally India is investing a lot towards creating expanding capacity to make sure that it doesn't become a bottleneck for us. The fact that we have such a vast coastal line, the fact that we are now dedicatedly investing in terms of the DFC. And again, if you think about it, India is also incrementally trying to create an alternative, something similar to one belt, one road, which China is doing. So again, we are trying to create our own source where we can have unrestricted access to Europe. So I think a lot of efforts have already been put. Government is continuously making an effort towards it. But the very fact that today the capacity utilization factor is less than 60% overall level, we will not be constrained for it. And I'm sure in due course, we will find even more and more infrastructure to support this whole thing.
Abhijit, this is going to be a very fascinating conversation, and I think you can keep going on like we did it last time in Delhi.
Yeah.
I'll try to bring it to another interesting conversation, especially on NFOs and HSBC mutual funds NFOs. Last couple of years, we've done a few NFOs together. I think we've garnered I mean, customers have got a lot of confidence in what we do. But how have these NFOs done? I mean, we're talking about exploring the opportunity, but how have HSBC mutual fund NFOs done last couple of years? A couple of funds that you can talk about now.
Yeah. No, so clearly, I think this journey started post integration for the benefit of everyone. If they recollect, in October 2022, L&T mutual fund merged with HSBC, and they created a bigger entity. Now, the benefit of this bigger entity was that we brought together the benefit of both. The L&T brought with us the scale and the size of distribution. HSBC brought with us obviously the benefit of the culture, the expertise, the processes. So when you combine these two, you created a very strong alternative within the mutual fund space. The first fund which we offered immediately after integration was in January 2023 when we launched our multi-cap strategy. Again, we had a similar view, and if you recollect the backdrop there, in the early part of 2023, mid and small caps were finding it hard to generate returns. I think people were again coming to the view that markets are expensive. These are the spaces where we don't have certainty. Where do we put that money at work? And at that point of time, we went to the market. We convinced our investor this is the time to put in money, because when everyone turns cautious, it's the time to turn greedy, and the other way around. So we found the opportunity. We invested in it. History has it. Today, we are almost touching 100% return in a matter of less than 2 years. NAV is touching 20 odd rupees. So that's the experience which our investors have had. Then somewhere in the end of the year of 2023, we launched our consumption fund. Again, when we reached out to market, everyone said it's a well-penetrated strategy. Everyone knows about it. Consumption is not doing well. Manufacturing is doing well in this country. Why are you launching a consumption fund? We did again bring to the market that we are going to create a very differentiated strategy here. We're not only going to rely on consumer discrete space staple, we're even going to look at the higher end of the value curve when it comes to K curve of spending, discretionary. We are looking at even the new tech offerings which can be part of this. Again, I think the investor, once they put in money today, we have generated more than 45% absolute return in less than a year. It's just touching a year now. So again, I think experience has been phenomenal. Talk about multi-asset, which we launched again somewhere in the middle of early part of this year. We realize that people are looking now, people have become more mature. People have kind of filled their coffers when it comes to having direct equity exposure. They want to have a more alternate asset allocation strategy. We created one with multi-asset asset allocation strategy. Again, if you look at in a matter of 6 months, this fund has generated more than 20% absolute return in just a matter of 6 months. Luckily, and again, this puts a pressure on me, but I have to tell you this. All three NFOs which we have done in last 12, 18 months, they are forget about the first quartile, they are in the top decile of their performance quartile when it looks at competitor and the peers in the absolute return. So I think our launching the product has been so well timed that we never launch a product till the time we have expertise and we believe it's a time to bring product to the market. It's proven in last 3 launches. Hopefully next year when we speak again on this platform, we'll have one more to that edition.
No, very aptly put. I think you're right. Over the last couple of years, the NFOs that we have got have been able to deliver outcomes on a very consistent basis. And I think a lot of that has to do with the fact that we now have a very strong analyst team, a very strong fund management team, our global, like you said, our global expertise and frameworks which enable us to invest systematically. I think that has played out well. Not to mention, I think when our customers have stayed with us for medium to long term, they have benefited from staying invested. So absolutely, I think if I could sort of tell our investors that when you deal with HSBC, you're not just dealing with two separate fund management entity and a bank. You're basically dealing with a single entity with a very combined and integrated thought process. The idea really is that we tell our customers to do what is right for them. We enable them to carry out a journey which enables them to fully understand the scope of what they are intending to do. The quality of products that we get on board are very well synthesized with our philosophy in terms of long-term investment, in terms of our confidence in the Indian economy. We try to definitely choose themes which are relevant and which really are going to play out over a period of time. But whenever you want to invest, please ensure that you speak to a financial planner. You have a full assessment and view of where you are investing. But great, I think Abhishek, what can I say? Fantastic, your fund, your NFO is up. We all are very excited. I think I've been traveling. We both have been traveling across different cities. The kind of questions we're getting from customers, very very exciting times. I'm continuing to get a lot of number of questions on the chat. Difficult to get all of them to be answered in a short time, but I think broadly very very incisive session today. Thanks, Abhishek, for taking us through this. Wish both of us all the very best. Let us take the best to our customers. Thank you again, Abhishek, for joining us. And with that, to the viewers, thank you for being part of this session. Thank you for being part of HSBC. Those of you who are not part of HSBC, do reach out to us, and we will be more than happy to help. Thanks a lot, and have a great weekend ahead. Thanks, Abhishek. Bye
Thanks,
bye.
Saibal, and thanks everyone. Thanks for your time. It was, as always, Saibal, a very, very insightful discussion. Looking forward to having more like that. Thank you.
Super, Abhishek. All the best. Thank you. Bye bye.